I don't know if you've noticed this, but every headline right now is absolutely brutal. Housing affordability, it's the worst on record. Deposits, taking more than a decade to get that money together. Rent, highest share of income ever in history. Buyers, they're completely priced out. They're finding it harder than ever. And now you've got commentators saying things like, maybe this is the end of the Australian dream. Maybe this is finally the breaking point. Maybe this is when the system snaps. So look, if you've been feeling overwhelmed, if you've been feeling like you're slipping further behind, if you've been thinking, what's the point? How does anyone get into this market now? Honestly, I don't blame you, because the new report that just came out, this massive Cotality housing affordability report, it paints one of the starkest pictures I've ever seen. We're talking price to income ratios the highest they've ever been. We're talking deposit saving times blowing out in every capital city. We're talking renters pushed to the absolute limit. We're talking conditions that we haven't seen in decades. And this new set of stats, this is the one that finally shows you exactly what Aussies are dealing with right now, how stretched people really are, and what the next 12 months are going to look like for anyone trying to buy a home or even hold on to one. But before you draw conclusions, before you assume you know what this means for prices, for demand, for investors, or even for your own chances of getting in, you need to see the full picture. Because when you put all of this data together, the affordability crisis, the lending data, the rental squeeze, migration numbers, government incentives, the behavior of buyers on the ground, a very different story starts to emerge. So let's unpack what Cotality just revealed and what it really means for the property market in 2026. Stay with me, because the twist in this story comes right at the end. So let's talk about what Cotality just uncovered, because this isn't vibes, it isn't opinions, this is hard data. 3 out of the 4 national affordability metrics have hit their worst levels ever recorded. Let's break that down. The first thing I want to cover is the price to income ratio. Nationally, it's blown out to 8.2, meaning the average home now costs over 8 years of the average Aussie's household income. For houses specifically, it's 8.9 times income. 5 years ago, it was just 6.6. Sydney, forget it. Houses are at 12.5 times income. Secondly, I want to talk about the deposit hurdle. To save a 20% deposit on a median home, nationally, it takes 11 years. Sydney is almost 17 years. Brisbane, Adelaide, and Perth, 10 to 13 years. Guys, 16 years is not a deposit, it's a career. Thirdly, guys, I want to talk about the rental squeeze. Tenants are now spending a record 33.4% of their income on rent. In Adelaide and regional New South Wales, for example, it's over 36%. And Cotality straight up says renters have now hit their financial limit. Not because rents got cheaper, but because they literally can't pay more. And this is where most people start panicking. If affordability is this bad, surely prices have to fall, right? Surely this is the top, right? Surely the market will finally slow down. Hold that thought, we'll come back to it. Cotality explains exactly how we got here, and it's not complicated. Over the last 5 years, home values have surged an incredible 47%. That's nearly $280,000 added to the median dwelling. Supply failed at every level. Construction costs have exploded. Many builders have gone under. Planning bottlenecks have choked new projects at the local council level. And at the same time, population growth has skyrocketed. It was the perfect storm. Demand went vertical, supply froze, and prices just kept ripping. And this affects everything: buying, renting, saving, even servicing a mortgage. Even today, after 3 rate cuts, a new borrower still needs 45% of their income to service a loan. Let me say that again: almost half your income just for the mortgage. This is why headlines are screaming crisis. This is why every young Australian feels like they're slipping further behind. And this is where the media pushes one message: it's too late, it's too hard, you'll never buy now. But is that actually true? Let's go deeper. So here's the part that completely flips this narrative, because while Cotality is telling you affordability is collapsing, ABS, Domain, Westpac, NAB, ANZ, AMP, SQM Research, they are all forecasting more price growth in 2026. Let me repeat that again. Affordability is at its worst levels on record in the data, and yet the smartest institutions in the country are all forecasting 6, 7, 8% growth, 10% growth, even 15% growth in some cases. And SQM, for example, is calling double-digit growth for multiple capital cities. And if you're thinking, how the hell can prices rise when no one can afford anything? Let me explain, because this is what most people miss. Prices don't move based on what everyone can afford. They move based on what the buyers with capacity can afford. And right now, Australia has 3 new waves of demand hitting the market at once, which is driving the market. Let's talk about wave one. First home buyers with 5% deposits. The federal government's expanded guarantee scheme is now uncapped. This means buyers only need 5% deposit. They pay 0 LMI, and it pulls forward buying timelines by 1 to 2 years. This alone will turbocharge competition in the affordable end of the market. Wave 2. Cashed up investors are returning fast. ABS data shows investor loans have surged to record highs, hitting $40 billion last quarter, above the 2022 peak. Why? We have had falling borrowing costs with 3 rate cuts this year, record low vacancies, rising rents, and a fear of missing out is building in the psychology of the market. Investors aren't slowing down, they're actually accelerating. We are seeing record levels of investors in the market right now. Wave 3, the immigration lag effect. This is an effect no one is talking about, and it's huge. Everyone's complaining about high migration between 2023 and 2025. Well, guess what? Those migrants finally get their permanent residency in 2026, 27, 28, which means they officially enter the housing market in these years. So you've got 2 years of pent-up demand about to hit the system. Combine that with continued strong migration, even if the government tightens selection, and you've got a multi-year demand pipeline that does not slow down. It is baked into the numbers. Here's what all of this means. Affordability will get worse, not better. The affordable suburbs, the ones under the price caps, the ones in that 30 to 50 kilometer radius from the cities, are going to get hammered by competition. These are the suburbs that will see bidding wars. 20, 30, 50, you'll even see 100 people at some inspections. A huge influx of first home buyers, a surge of investors, and interstate migrants following affordability. These pockets will not stay affordable. In fact, based on the data and based on what I've seen for the last 10 months, these affordable suburbs are the ones that will 2 times in value over the next 4 to 5 years, not the premium suburbs, not the inner city trophy markets. It's going to be the affordable pockets. That's where the tsunami of growth is going to go. And now let's address the big fear. Scott, if affordability is this bad, won't the market crash? No, and here's why. And this is the part Cotality doesn't tell you. Unaffordability does not cause price drops. It causes choke points, it causes bottlenecks, it causes surges into the few areas people can actually afford, meaning prices won't fall. They'll get more uneven, and the bottom 30% of the market, the affordable tier, is about to explode. This is exactly what Domain, Westpac, AMP, and ANZ are forecasting, and you can see it happening in real time. So here's where I land on all of this. Cotality is right. Affordability is at the worst levels we've ever seen. People are stretched. Renters are at breaking point. Saving a deposit is harder than ever before. The market is not slowing down. In fact, and mark my word on this, Cotality's affordability crisis will push more people into the affordable segment, which will push demand higher. It will push prices in these areas faster. And now let me say the part nobody else will say. I think the forecasts from Domain and the banks are still too low. Domain says 6 to 7% growth. Westpac says 7%, SQM says 10%. Telling you right now, in the undervalued suburbs and in the affordable pockets, we're going to see 9 to 15% growth in 2026 alone. And over the next few years, many of these suburbs will double in value. I've been saying this for 9 months. I said it at the start of 2025, and now every major institution is finally catching up. So here's my question. Are you going to sit this out and hope affordability magically improves? Or are you going to get ahead of the wave, get ahead of the curve, and get into the market now? This is your daily property update, your 5 to 7 minute update every single day on the property market so that you can be a property insider. Make sure to hit that subscribe button so you never miss an update. By the way, if you're interested where you should be focusing your attention about where you should invest at the moment, I've put together this video, watch this video, and I've got a few others on the different capital cities that you should watch also. Go ahead and check that video out now.